Hello, everybody, and thank you for joining us today. Today, we're going to be looking at navigating the transition from employment to self-employment. We've had a lot of conversations recently about individuals considering leaving their current employment, starting their own business, maybe looking to start a consulting business. So wanted to really share some expertise here today, and we've got a really great panel looking at all different aspects of this transition. So very excited to be sharing this topic today and to have our experts joining us. So without further ado, I'll introduce everybody and we'll get started with that. So quick note of disclaimers for compliance so we can post this later. But once again, a big thank you to our speakers who I'll be introducing in just a moment. So we have a wonderful panel today. We've got Chantel Goldsmith here, who's a guru on the HR and employment law side of things. So very excited to have you, and thank you for joining us, Chantel.
Thank you for having me.
We also have Anurag Gupta, who many of you might know. He's great on the will side, on the corporate side, and he brings a wealth of experience on the legal side of things. So thank you for joining us today, Anurag.
Thank you, Eric.
And last but not least, we've got Neb from the TMFD team. We have clients that do taxes through our teams, and Neb is one of the primaries there, and has got a wealth of knowledge on the corporate and personal tax side of things. So very excited to have Neb share his experience with us today as well.
Excited to be here.
Wonderful. So thanks, everybody. And without further ado, I wanted to share an overview today just so we can set the table for what we're going to be talking about. But basically, we want to look at a few things. Number one is thinking about making that decision. So what are those considerations? If you're thinking about either starting your own business, starting a consulting business, what is the mindset? What are the questions you should be asking yourself? Number two, and now that you've decided if you're going to make the jump, what are the legal considerations that you have to keep in mind? What's the structure? What structure options are there? When should you be taking those steps? What are the implications for making those structures? So we're going to delve into that with Anurag sharing his expertise there. We're then going to look at financial planning considerations. As you're joining a new business or starting a new venture, there will be costs. There's going to be cash flow constraints. So making sure you have your ducks set up financially is going to be vital. We're going to talk about that. Then we're also going to look at HR benefit and employment law considerations, such as what are you leaving behind, what considerations are when you're starting a new business to make sure you're not setting yourself further behind. So we're going to look at all that in section 4. And then finally, we're going to look at business structure and taxation. So look on the accounting side of things, what that means for you, what the differences are between being traditionally employed and self-employed. So lots to look at today, but very excited to get started on this and to start the conversation. So number one, I want to talk about making the decision. I'll open it up to the panels now. Are there any questions that you think are helpful in sharing with individuals that might be thinking about making this step? I mean, I can start for one, looking to make the transition from employment to self-employment is a big undertaking, and it can take a few years for somebody to make the same income that they were making previously that they're making now. So for one, thinking about that mindset of, I have to be mentally prepared to maybe take on more in the sense of expenses and take more in the sense of getting up to employment. That's one of the questions that we're looking at. Are there any others that come to mind or that you'd like to ask individuals that are thinking about making this transition?
I think personally, one of the things that I like to ask individuals is what they're willing to be giving up, because you have to think when you're an employee in a situation, there's a number of benefits and rights that you're entitled to that you would be losing as a result of becoming self-employed. You would either have to go and get those benefits on your own or find alternative means for like investments. Like, for example, if the company you worked for had a pension plan in place, you would lose out on that pension plan or those contributions. So you'd have to figure out a way to make your own investments for those kind of needs.
Yeah, that's a great point. And something that we'll delve into, but definitely, I mean, making that transition from employment to self-employment, you're usually giving up a lot of those benefits. And Chantel, this is something that we can delve into a little bit later, but you mentioned when somebody's looking to take on a new role, is there a number that they should be looking to keep in mind in the sense, or a percentage that is helpful as a baseline for saying, hey, if I'm starting as a self-employed, should I if I'm negotiating an employment contract per se, is there a value or is there a number I can keep in mind to make me whole in the sense for what I'd be giving up? Is there a rule of thumb?
Sure. So generally, as a rule of thumb, if the individual does not have like a group RSP match or a pension as part of their remuneration, then normally the number is about 15% is what their markup would be for their further benefits of employment. That would be things like health and dental benefits, disability benefits, life insurance benefits, those kind of things. If the individual does have an RSP match or a pension, usually we bump that up to about 20% to 25% of what their base income would be as that value for those further benefits of employment.
Good food for thought. So if you are looking to making that transition and you're thinking about hopping on as a consultant, which is something that we've seen recently, I mean, Anurag and I and Neb have had a few of those conversations recently. Keep that in mind because you are likely foregoing that on that side. So 15, 20% in the sense of those benefits. Anurag, Neb, anything else to add on the initial thoughts or when you hear?
I always say, because I did the same thing. I went from, working at a law firm in Ottawa and then moved to Toronto and started my own practice. I always say, never ever burn bridges where you're at. Because if worst case scenario, if you've worked at the last place before you went to self-employment and you had a good relationship with that team, don't burn the bridges. Because if the self-employment side of thing doesn't work for you in the future, obviously you want to go get a job again. So you may want to go back to your old mentor or boss or whatever you were working at. That way, if anything goes wrong or you don't feel that self-employment was for you and you felt that the employment, I like the holidays, I like the RSP contribution, I like the other medical, dental health benefits, at least you have a safety net. Other than just having a safety net with cash, because if you're on your own, so if you're like an individual with no family, that might be your only savings. And if you have a family, make sure your spouse is also able to make sure that they can sustain the family, expenses, just in case your venture doesn't pan out.
Along the lines too of not burning bridges, oftentimes I see a lot of individuals who enter into these consulting careers of going back and working as a consultant oftentimes for the company that they left. So there's a lot of times that happens, and oftentimes industries are small. You end up seeing the same people over and over again, or you need to utilize the services of those people, whether they become your clients or whether they become your distributor or whatever they may be. Industries are small, so you do want to keep those relationships still as best as you can.
Yeah, that's a great point. And lastly, on this topic, anything that you like to remind individuals, or are there any pieces of wisdom that you like to share if people are making these decisions and they're coming to you either for advice or for guidance? Other than we talked about those, Neb, is there anything that you've seen from accounting perspective in this decision point?
Sure, yeah, absolutely. So, I mean, as others have touched upon it, from the financial side, I think it's willing to take on that additional risk. Typically, the self-employed individuals are not going to have guaranteed income. They may have contracts that are maybe on an annual basis or things of that nature, but it's up to them to kind of get their own contracts and kind of secure their own income versus when you're employed, right? It's sort of a little bit more guaranteed. That being said, though, when you are self-employed, there's a little bit more benefit and flexibility on the tax side. You get some of the benefits that include being able to deduct expenses, which is significant when it comes down to reducing your tax burden. And I think that's definitely one of the key advantages when you do transition to self-employment.
Perfect. Well, that's great intro, and we're going to delve into all those topics. But for now, I think it really goes to show how it's important to have all of these ducks in a row and boxes lined up. I mean, there's the legal side, there's the tax side, there's the employment, there's the benefit side. So there are really a lot of considerations when you're looking to make this decision. So having great people like Anurag, Neb, and Chantel in your corner is going to be vital, because it takes a lot of information and you want to make sure you're starting off on the right foot. So hopefully we've teased out some of those questions in this first section here. So let's delve into our second part. So looking at the legal considerations. So let's say you've flipped all your cards, you looked at it and you say, you know what, this is something that I want to do. Anurag, can you tell us a little bit more about what that next step is from a legal perspective? If you're moving to self-employment, do you have to incorporate right away? How does it work if you're a sole proprietor? If you can just outline, so what are the options and what next steps individuals should take?
Well, the first step whenever clients come to me and they ask me, hey, I'm going to be a self-employed individual, should I incorporate, should I do this? So the first thing I ask them is, what business are you offering? What products or services are you offering? Are you going to be making widgets? Are you going to be a consultant? Because that goes important with the structure because, for example, if you're making printed cards, so as an example, you've been making these cards, handcrafted cards at home, and you've been giving them out, and a friend of yours say, hey, these are really good, cards, you can run a business out of it. Well, in that situation, the liability might be minimal, but the venture itself may result in not what I call a significant expense, but a decent amount of an expense. Okay. And if you're still employed, a little bit and not really giving up your employment, you may not want to incorporate in that situation. And you may want to just run as a sole proprietorship. That way you can offset those business losses against your employment income. However, if you're making widgets or if you're selling, say, chemical paint or something, other business which results in liability, then having an incorporation is probably better and more favorable in the event that the company gets sued. Because if you sell a product and you become liable for it, it depends who sold the product. Is it you as an individual or is it the corporation? Under the law, any individual corporation is considered a separate legal distinct entity. Unless a director of the company is personally negligent or is committed a fraud, then they will get sued personally, but that doesn't mean that they have to actually, give the reward out if there's any lawsuit against them. But going back to the company side of things, then you have to ask yourself, am I doing this business with myself? Is it my family members who are involved in the business? Am I entering into a business, say, for example, with you, Eric? Because then we may want to either set it up as a partnership of corporations, a partnership of individual and a corporation, or combination. Okay. The other side of the things is, other than liability, it's also the tax considerations. As everyone, or as most people know, individuals are taxed in Canada based on their graduated rates. So the more you make, the more you get taxed for that extra portion of income you earn. Whereas in a corporation structure, if it's a small business corporation or what we call Canadian controlled private corporation, they may be afforded a small business deduction rate, which is about 12.2% NEB. Is that correct? It's 12.2%,
Correct.
right?
Yes.
Yeah.
Yeah.
So it's 12.2% that you're paying tax rate on versus, say, 53% at the highest marginal tax rate as an individual. I hate to say this, but I have colleagues till today who are lawyers, have never incorporated, and they've remained as a sole proprietorship. Okay. So there's a significant number of savings you could do incorporating. But like I said, just because there's tax considerations and legal liability considerations, you have to ask yourself, when you're starting a business venture or consultant or whatever, what are my expenses going to be in the first 1 year? Are they significant enough that I may not generate a profit? And if you're not going to generate a profit and I'm still working part-time at my current employment, and depending on the liability of the venture that you're providing, then maybe incorporated isn't the best in that scenario. And we may want to wait until the business actually gets off the ground.
That's a great point, because we often get the question, hey, I'm thinking about starting my own business. Can I incorporate? I want to incorporate right away. There is a benefit if you're incurring losses in that first year, as Anurag, you pointed out, to have that offset some of your other income, especially if you're still working, or maybe you work part-time through the year. So that's a very important piece. So I guess to that point, go ahead.
Sorry, and there's some other consideration of incorporating, as you know, Eric, that if you have a successful business and you sell the shares of the company, assuming other requirements of the Income Tax Act have been met, there's a possibility you could walk away with, and I'm just saying as an example, about $1 million of potential tax-free money per shareholder. And if you have a family of 4 or 5 people, that's potentially $4 or $5 million worth of tax savings you could have that you would have to pay taxes on as a sole proprietor. But again, those structures are not easy. They're complicated. And we can get into that towards the end of the discussion.
No, that's great. And then lastly, on that point, can anybody incorporate Anurag, or how does that work?
Yeah, so up until a few years ago in Ontario, to incorporate Ontario, you needed to have a Canadian director, resident director. Because other provinces like Nova Scotia and British Columbia, sorry, it was a New Brunswick and British Columbia, you didn't need to have a presence of a Canadian director. Ontario removed that requirement, so anyone can technically incorporate. So it doesn't matter so long as you're of sound mind. If you're going to be a director of the company, you have to be above 18. And the reason you have to be a sound mind is because a director cannot should not be someone who's of unsound mind, and they cannot be bankrupt. So I can incorporate if I was, say, bankrupt, but Eric, you can be the director of the company. So I could be the owner of the company, for example.
That's great. And then lastly, if somebody wanted to incorporate, what would be those next steps, and what does that look like, either from a cost perspective or from a go forward perspective? If you can share some light on that.
Yeah. So whenever clients come to my office and they say I want to incorporate, the first question I ask them, who's your accountant? Okay. And the accountant, if they go to an accountant, the accountant will generally say, okay, we need a lawyer to incorporate. Okay. And I would love to work with the accountant on the file, because at the end of the day, we have to work as a team, make sure that what we're setting up the structure actually is a structure that's, for example, feasible, but also works for that family. Because you could have, for example, let's take a doctor as an example. If there are two doctors in the family, both the spouses are physicians, they may want to consider, for example, having two separate corporations and not have a cross ownership. It's not often enough that I see that, for example, I've seen the physicians where they come into my office, or dentists that will come into my office and say, hey, my wife and I are both shareholders of 3 different corporations. So I'll be like, why, for example, right? Because of the small business deduction rate, as an example, you have to then share it amongst all the 3 corporations in that situation. But if you could structure it in a way that you don't have to. So in cost-wise, it depends the type of corporation we're setting up. If it's a simple one, then yes, the costs are cheaper. If we're working for multiple shareholders, the cost can increase as well. And then we will also talk about not only just tax structure, but shareholders agreements. And there's other wrinkles that will go along with it. And then, we reach out to firms like Chantel's, there's employees that are coming on board. So employment agreements that may have to be drafted for people, because we don't do employment agreements generally.
Perfect. Well, I think that gives a really good intro to what those considerations are when you're looking to get incorporated. Basically, to summarize, 1, don't rush into it. Have a conversation with a lawyer, see if it makes sense, and then work closely with an accountant to also see what the strategy is for incorporation. So I think that's a great start there. Anurag, thank you for sharing that. All right, so we'll hop to number 3, unless anybody has anything to add there. Our next topic is financial planning considerations. So, this touches on everything from step 1 to the legal side, but really there are a few things to keep in mind. Number 1 is there will be some costs. So if you're looking to incorporate, it's going to cost some amount. So make sure you have some money that's either liquid or available. Number 2, you're likely taking a tax hit or an income hit in the first few years of starting a business. Unless you're hitting the ground running with contracts that are already allocated, set yourself up and mentally prepare and budget for the next few years being a little bit leaner. If they're not, great. But what that means, we generally like to prepare our clients in that light to say, okay, prepare for a lower level of income, scale your expenses, and try to operate in survival mode for at least the first few years to see if this is viable or not. You don't want to take you're taking a big risk in jumping and creating this new opportunity, which might work out great, but make sure that you're giving yourself the best chance of success. And that means bringing your expenses down when you can, and doing all you can to protect that income for the family. So, a few things that you want to do before you decide to make that jump. So if you're currently employed, one really great thing to do is to look to see if you can get a line of credit. If you don't have a home or a home equity line of credit, Set that up before you decide on making this change. It becomes much more difficult after you've made the change. So once you're employed and you have T4 income, the banks will likely want to lend to you, which is a great time to have this set up. So get your ducks in order. And what this means is that you don't have to use it, but you have this access. Because as I mentioned, you're going to have more costs, and you want to have these aspects in your favor and at the ready. So if you're making the change or before you do, have a look to see if you have a line of credit set up, increase that if you do, and make sure you have some capacity there. So that's one of the big tips. The second one is know what you're giving up. So we mentioned it with Chantel, spoke about the group savings plans and the pension. The business, in a sense, becomes your pension or becomes a savings plan. At least that's what we've seen for a lot of clients. They devote all their energy and they grow the business. We'll do a part two where hopefully you're on the other side of this and you've built up some wealth in your business, and we'll look at strategies. But in those first few years, generally in our experience, the business becomes a savings, and you're just trying to keep this afloat. So you want to run it as lean as you can, and you want to make sure that you're not going overboard on expenses. So being very minute and detailed on those expenses, on those outlays. Sure, it might be fun to be your own business owner and spending freely, but remember, at the end of the day, you need to make sure your business gets off and running. So you want to be very fixated on those costs and want to keep them as low as possible. And then a few other things. There are a few other aspects. We'll get into this with Neb on when we structure this. But now, if assuming you become incorporated, you now have a choice. So money goes into the corp. You can pay yourself out as a salary or as a dividend. And how you do that will impact your taxes and that financial side of things. So we have a few more levers to pull from in that sense from when we're simply taking a T4 income. So we'll get into that in section 4 and section 5. But that's another big consideration, is how do you pay yourself? What's the benefit to paying yourself salary versus dividend? And how does that work from a tax perspective? So a little bit of a teaser that we'll get to in section 5, but those are some of the big considerations. The last one is make sure you have a cash buffer. You're going to have more expenses. You're going to have likely tax installments to pay, which usually were paid from the company, so you didn't even see those. Likely in your first year, you won't have to pay installments, but the second year, if the government notices that you didn't make your payments through the year, you're going to have to start paying quarterly installments, and you're going to have to start saving that money aside. So you don't pay the high interest that CRA requires. So being diligent with building a cash buffer is going to be very important, especially in those first lean years. So I'll pause there. Anything else, Neb, Anurag, Chantel, that you wanted to add in terms of the financial side of things before we jump to number 4?
I always say always meet with a financial advisor as well. And I like your idea of, making sure that you get a line of credit. They always say always get credit when you can get it rather than when you really need it. That way you have a safety net. And then maybe also talk about, some situations I've advised clients in the past. Listen, if you have a nest egg, so you don't blow it all in a venture, for example, take a portion of it, invest it, put in a safe income like GIC as an example. At least it's earning interest, but you're not dipping into those funds, and that, okay, I put $100,000 aside. Well, my venture is eating up what I thought it would eat up. It's eating up more. And now I have to dip into this 100,000. That might become kind of like a psychological, marker, for example, and saying, hey, maybe I shouldn't continue with this venture. Now I have to dip into the extra savings, as an example. So it's a good idea to talk to the financial planner up ahead as well. And then also, if you've got because as you were working as an employee, there's probably RSP contributions you probably made. So if you need to cash those out, what is the process of cashing those out for the venture? So along with any potential taxes that may have to be paid in cashing those RSPs out.
Right. And just an aside, I'll add a few details on that. So we generally see that this happens often with individuals that are either leaving their current employment, retiring. If you've built up some retirement savings, generally the way it works is after you've submitted your resignation, within a month or so, you'll get a statement of options, and then you have choices to make. So you can either, as Anurag mentioned, you can cash those out, you can leave them as is, or you can transfer them to another institution. If you cash those out, there are likely significant tax impacts, especially if it's an RSP, because RSP is made with pre-tax money. So if you take that out, then you're going to be paying withholding tax. It's going to get added to your income. So if at all possible, you want to keep that as is, unless there's significant reason for you to withdraw that. But that's definitely something to keep in mind. TFSAs, those can transfer, no tax implications there if they go from TFSA to TFSA. And the other one we get is usually a pension. We sometimes see with older pensions, you have the option of commuting, either moving it to an annuity or commuting your pension and building your own pension in a sense.
Can I step in and say one more thing, if you don't mind?
Yes, go ahead.
If you're married and you own the house jointly with your spouse,
Right.
the spouse who is not going to be a business owner, assuming the other spouse isn't already a business owner, and if it's possible to transfer the house into that spouse's name before you start your venture, so long as you get mortgage approval in that spouse's name, it's always a good idea to do so. And I believe, I'm not saying it would, but I believe that might also defeat any potential fraudulent conveyance, because you didn't start a business, you kind of gifted it to your spouse. So
Right.
that's the other thing you may want to consider about, with assets, how to protect them wherever you can. It's better to do it before you start the business rather than after you start the business, especially if you find out that there might be potential lawsuits.
And along those lines as well, while you're talking about mortgages, I think it's important to consider that most banks are willing to lend money for mortgages when you're employed. It's a lot harder to get a mortgage approval when you're self-employed, because I believe they go back at 2 years of self-employed income, or you need 2 years of self-employed income for their consideration for something like that. So if you have a mortgage coming due, you may want to consider renewing the mortgage before starting the business itself.
Yeah, that's a great point. I mean, once the business gets up and running, you have some retained earnings, the banks tend to want to lend to you, but you're right, in those first few lean years, it might be a little bit more difficult. So certainly a consideration if you do have a mortgage or you're looking to buy a home as you're taking on this business venture. So great piece on that. Okay, wonderful. So let's go to our next section now. So let's look at the employment side and the benefit side, the considerations. Chantel, are there any tips or is there anything that you'd like to share with clients that are making this transition, especially looking at this area in particular?
Yeah, so we already discussed what the idea is of what you could be losing potentially by starting your own business and having to go out and get those benefits for yourself. So that's when you would talk with your financial advisor, who will have some ideas for you on how you can have your own self-insured plans in place to protect yourself and your dependents upon needs, for whether that's life insurance needs, whether that's disability or CI needs, or whether that's just regular health and dental needs for yourself and your dependents. So that's a big consideration to have to make there. Also, things that you're considering that you're losing out on potentially are protections under things like the Employment Standards Act, or under the Occupational Health and Safety Act, things like that provide for benefits for employees that may not provide the same duty of benefits to people who are in self-employed or contractor type positions with the company.
And now what about, I mean, maternity and those types of leaves? Does that even exist on the self-employment side?
It doesn't. So, or vacation time, like all of that kind of stuff. You're not going to be getting paid vacation pay. You're not going to be able to generally receive EI benefits for leaves of absences. So whether that's a sick leave benefit or whether that's a maternity leave benefit, there's going to be times where you're not going to be entitled to those kind of things. So you're going to have to really self-insure yourself by putting money aside. That's when you really need to be working with your accountant and your financial advisor to make sure that you're having that little nest egg set aside in case you do need to utilize those kind of funds for those types of leaves in the future.
That's a great point. And you mentioned the self-insurance. That's a great piece. So one of the things that we like to share is, one, if you have a spouse and they have benefits, worth looking to see if you can join that plan. Oftentimes you can, so you can at least have one level of coverage, and that way you can spread that nest of protection in that sense. If that's not an option, then as Chantel pointed out, you should look to self-insure, and there are a few options. I mean, life insurance is one. Generally, if you work for a company, you will have a small amount of life insurance, but it's generally not transferable. So if you leave, it's gone, and it usually doesn't cover the needs that you have. So usually if you only have group life insurance, it's a small portion and you might need additional insurance. So especially if you own a home, if you have children, that's definitely something that you want to be speaking to your financial advisor or us and we have some insurance partners that we can work to and look at that. So that's on the life insurance side. There's also the critical illness and disability, and that gives you coverage in the event that you can't work. And those are additional levels of coverage. Life insurance is in the event that you pass away, you get that money. So those are two different levels of coverage. But one, I would check to see, does your spouse have benefits that you can qualify for? Do any of those fall under that umbrella? And if not, you want to be speaking with us and our team to see what that looks like if you want to build your safety net. Because you're taking on some excess risk. You want to make sure that your family's protected. And if you're the only person running the show and you get sick, you want to make sure you have some parameters in place so that all other areas of your life don't go into shambles or in disarray. So you want to get those ducks in order as well. Let me see. Was there anything else? Employee benefits, we talked about, insurance, retirement plans. Good time to look at maybe business structure. Now, before we look at that, Chantel, anything on the, if individuals are negotiating contracts, say they're moving from traditional employment to becoming a contractor, is there anything that you advise or any tips or anything that you look out for? That's something that we seem to be seeing more in recent years as employers are less likely to want to have to pay out these benefits. They're offering more positions to individuals as contractors. Is there anything that you advise individuals if they're looking at this transition, or anything that you caution them against or to look out for if they're in that position?
Yeah, so there's actually, you want to enter into a independent contractor or a dependent contractor agreements if you are looking to become in one of those type of roles. The reason you do that is it gives you some protections against the company that you're providing services to, and it provides the company with some assurances as well. So most companies want some sort of adequate confidentiality provisions or non-solicitation type provisions or things like that in there, as well as there would be, the biggest component of it would be the termination provisions. So what kind of notice you would receive if the company you're providing services for as a contractor decides they want to terminate your services. So that will give you at least a little bit of a leeway to be able to find another client, to be able to still have gainful money coming in to ensure that you're protected, your dependents are still being able to be cared for and all that kind of stuff, to make sure you have that kind of transition. So you do want to work with a lawyer before you enter into any sort of agreement with a potential client of yours as a contractor, to make sure that you have that independent contractor agreement established.
No, that's great. And then at what point should somebody look to engage with somebody like you on the employment side if they're looking to make this change? What's a good time to say, hey, I'm thinking about this, can you help me? Or when would you advise individuals to seek out either your services or somebody in that space?
So you want to make sure that you have a contract in place before you start servicing the client that you're providing services to. So you want to ensure that you have that already lined up, set to go. So I would say probably right after the incorporation, when you're in the midst of finding your clients that you're going to be servicing, that would be the time where you're going to be working with an employment lawyer to really have that contract ready to go, so that when you do find that client, you can be like, okay, here's my independent contractor agreement that we can enter into for their review and consideration with their own counsel.
Beautiful. No, and that's a great piece, because there's going to be a lot on the go. You're starting a business. So I think the most important part, at least in speaking with everybody, is making sure you have somebody in each of these roles. So, before you start this venture, knowing that, okay, you've got a team, you're going to need some help because there's a lot there and you can't do all this on your own. I'm sure you can Google it and try your best, but I think the best piece of advice is making sure you have some sound individuals that can help you with this. And that will really set you up for success and will allow you to focus on growing the business rather than doing the nitty gritty that you might not be an expert in.
Exactly. And working conjunctively as a team together, right? You want to ensure that all of your professional advisors are all working together, because I really think that will tie in all the different pieces together as easily as possible for you. And then in the future, if anything should arise, you can reach out to all of those individuals who then know each other, hopefully, and can provide you with the best advice going forwards.
No, that's a great way to put it. And that leads in nicely to Neb's section on business structure and tax considerations. So we've talked a little bit, let me go back up here, about the legal structure, but now let's delve into the tax side of things, Neb. So can you tell us a little bit about what it looks like once somebody becomes incorporated? What does that look like from a tax perspective? What should they be mindful of? And then we'll talk about maybe some expenses and what that looks like. But yes, Neb, if you can share some of those thoughts on that.
So assuming now you've moved on, you're self-employed, you've decided to incorporate, the first step in that process, you're definitely going to want to open up a corporate bank account, open up corporate credit cards. This is going to help for the bookkeeper who's going to be tracking your income, your expenses. Just make sure everything is kept separately from your personal side. With that, you want to then make sure that you're going to determine how you're going to pull money out if you are profitable. When you are determining that, there's kind of two options to go for from there. You can kind of choose whether you want to do a dividend or a salary. So assuming now you've been going on for a few years, you've seen, hey, you know, I've made a few $100,000 in profit, I can kind of pull stuff aside. You want to first kind of go with your financial planner, kind of set up a meeting and go on to kind of discuss whether you want to do the dividend or the salary. The dividend, some of the benefits are that you are able to draw the money out kind of more flexible. You don't have to kind of stick to a consistent payroll structure. You can sort of just draw the funds out as you need them. The downside being there, you kind of have to keep in mind that as you draw those money out, nothing is being withheld to the government. So come, you know, the personal tax time, you're going to have to expect a relatively large tax bill versus if you are doing salary, that's kind of typically where the funds are automatically withheld each paycheck. And then at the year end, you're already kind of good to go. And the net pay you've received throughout the year, you know that you're able to kind of spend it as you need it for personal expenses. Some other considerations there when choosing between dividend and salary is that if you decide to go down the salary route, you will have to contribute to CPP. Some people consider that a positive, others may consider that a negative. It's sort of a forced retirement savings. Others may just choose to save on their own. And in that case, they may want to opt for dividends. In terms of salary as well, if you choose to go down the salary route, you will be able to build RRSP room. So that's another key financial planning tool that you can use down the line to help minimize taxes personally, whereas dividends, they don't generate any RSP room. Looking at the overall tax effect between dividends and salaries, the CRA has sort of integrated a system where everything is kind of washes out. While if you do take a salary through the corporation, you will get a deduction for that salary in the corporation. You will be paying a little bit more taxes personally versus where if you do take a dividend isn't considered a tax deduction in the corporation. However, you will pay a little bit less tax on the personal side. Some other things to consider as you are growing your business. If your business does go over $500,000 in income, be prepared to pay additional taxes. So you're going to be exceeding that small business deduction. Once you go over $500,000, you're going to be looking at a 26.5% tax rate in comparison to the 12.2%, which is that under 500,000. And I think that is from the income and kind of expense side of things, incorporating. When you're also incorporating, I know this was kind of briefly touched on previously, you have to look at the different structures you're going to be potentially setting up, who you want to add as a shareholder. There's certain benefits and certain negatives potentially to adding shareholders. So if you have maybe multiple, you and your spouse kind of both want to work, you may want to have separate corporations so you're not sharing that small business deduction. Another scenario is you may have a spouse who doesn't work or children. You may want to add them as shareholders in your corporation. So ultimately, when you go down to sell the business, you'll be able to kind of utilize that lifetime capital gains exemption, and each one is about $1 million. So that's also another thing to consider there.
I want to touch on that's great. Now it gives a real overview of some of those moving pieces. You mentioned say RSPs versus saving in a corp. Can you talk a little bit about the nuance between those two? RSP, TFSA, and corp, and how you think of those in conjunction. So what should individuals be thinking about when they're either looking to save in the corp versus RSP or TFSA?
Sure, absolutely. So when you're saving in the corporation, you can sort of just kind of set that money aside. And if you want, you can invest it in the corporation. When you invest the money in the corporation, you can kind of let it grow there. You are going to be subject to a higher tax rate. It's close to 50% for passive kind of income. Some of that can be recouped if you issue yourself dividends. But whereas if you're doing an RSP strategy, any money you pull out from that corporation and any money you pull out from that corporation and kind of invest it into your RSP, it's going to be a tax deduction on the personal side. Obviously, the money you draw out is going to be income, so it's kind of a wash. But then when you do invest that money in the RSP, that money is eligible to be growing tax-free. And then ultimately, ideally, you can kind of pull that money out down the line when you're in a little bit of a lower tax bracket. Maybe you've retired now, you're not taking as much income from the corporation. And then, yeah, you can just kind of draw it out at a much lower tax rate personally.
And what about investing in the corp versus TFSA from a tax perspective? Anything that you share with clients on that way?
Sure. I mean, other than just kind of the same things, when you're investing in the corp, you're going to be taxed at that higher rate. Whenever you pull money out of the corporation, sure, you're going to get the tax hit, but down the line, when you put it in your TFSA, the money is eligible to grow tax-free. So you can have it in that account, for the next 20, 30, 40 years, whatever. And all the funds and all of the investment income you earn over time, it's all going to be tax-free. And then again, you can pull out all that money tax-free because you used after-tax dollars to invest in the TFSA.
That's a good point. I mean, so the nice thing about being a business owner is that you do have more options in that sense. So you're going to have a few more withdrawal sources. Yes, there's a little bit of complexity, but with some planning and some financial advice on that piece, you can structure it so you have a few different buckets from which to pull from and really level set on how much you're withdrawing and how much taxes you're paying. So, I mean, Nav, those are three great points and how we like to conceptualize it. There's no real one size fits all, but it's about knowing what the implications are for these decisions when you become a business owner and you've got money to invest and then to withdraw. So great points on that. What about GST, Neb, GST, HST? How does that work and how should clients think about that and plan for that?
Absolutely. So when you incorporate, typically you're going to receive a business number from the CRA. But as you incorporate, if you're going to be providing taxable services in Canada, essentially, if your income is going to be over $30,000 annually, you're going to need to register for HST. Now, there is a caveat. Some professions are tax exempt. For example, if you are a dentist, you may provide tax exempt services, and in that case, you wouldn't need to register for HST. But for the most part, 95% of the people are going to need to have their business register an HST account. And then once you do register an HST account, you're going to need to start charging your clients 13% on all invoices you send out to them. That being said, you can reduce the amount of HST you have to pay to the government, and that's reduced by any HST you've paid on expenses. So any HST you need for your business, any expenses that are paid for the business, any HST you paid on those expenses are deducted against HST collected, and then ultimately the net amount is remitted to the Canada Revenue Agency.
That's a great point. So, I mean, there's a lot of moving pieces on that front, but that's why we always encourage work with an accountant. I mean, there's always individuals that want to do everything themselves. There's so much you could be doing to grow your business that you want to make sure you're saving that time for you to focus on those most important activities. So I can't stress this enough, the importance of having great people in your corner that know these aspects, the GST, the HST, the legal side, the employment side. So you can rely on them and then you can focus on bringing those big clients in and growing the business. So great point on that. And then lastly, I wanted to ask you about tax write-offs and deductions, because that seems to be a magic word, but not many people understand it. So how does that work in terms of what you can write off? What are the expenses, and how should new business owners think about that?
Absolutely. So, I mean, what you can write off is generally very broad. It's all going to be dependent on the type of business you have and the type of expenses you're going to be incurring. In general, what I like to tell clients is if you can sort of link the expense towards your business, then you should be fine to write it off. And this can kind of include everything from, advertising, donations, license fees, regular office supplies, an automobile. That's just to name a few. I mean, there's quite a broad range of expenses. As long as it's sort of linked to that business, you should be fine to write it off. Just one thing to make sure of is to keep all of your receipts. The CRA does like to conduct audits, and if you're not prepared and you haven't tracked all of your receipts, and the CRA sends you an audit request, you're not going to be able to fulfill it. And in many cases, they will deny expenses if they don't see receipts. So something important to keep in mind.
And how far back can they go if they do request an audit?
They can go back up to 7 years.
And then what happens if, say, they audit you 7 years back and you don't have a receipt for that expense? How does it work from a tax perspective? How does the CRA?
So there are a few things that may happen. One, they may be nice and say, okay, you can't find that receipt. Can you go back 6 years and find this receipt? Something along those lines. And then they may be nice and allow it. But more often than not, what they'll do is they'll deny that expense. So that expense reduced your taxes in that specific year. So you would have to pay the taxes that you would have owed without that expense. And on top of that, they're going to throw an interest for the 7 years that you owed the taxes. So there's a potential for a lot of penalties and interest there. So just make sure to save all receipts.
That's great. Any tips on being organized and saving those receipts? Are there any tools that you like to share with clients in that regard, put their minds at ease?
It could be just as simple as keeping a binder with all your receipts, but we see a lot of clients now, they like to scan in receipts and kind of maybe keep it in a Google Drive or a Dropbox. That way they don't have to worry about losing it or the receipt fading over time. They sort of just kind of keep it online in a secure location, and they usually have 1 or 2 backups just in case something goes wrong. And then that way you just have peace of mind that, you know, it's somewhere there and it's easily accessible, and you can kind of use them as needed.
That's great. Okay, well, I think that'll wrap this section, unless Chantel or Anurag, you had anything to add, but I think we've touched upon a few very important topics and considerations in looking to make that jump from being employed to being self-employed. We'd like to do a teaser for part 2, where we're now looking at growing your business. So maybe you're a few years in and you're looking to expand. So what that looks like in terms of hiring employees, what the labor and employment implications are for that, how to get your contracts in a robust place. So you make sure that you're setting that foundation when you're bringing on new contractors or new employees, what you can do from a corporate standpoint, say, do you need a trust? How do you structure yourself? Maybe you're getting shares in a new company. We'd like to look at some more specialized implications. So we'll do that in a part 2. And then we'll also look at maybe investing in your corp if you've built up some sizable assets there and you're growing more than you're withdrawing. So we've got certainly some more to delve into. But for this first one, wanted to thank Chantel, Anurag, and Neb for really sharing their expertise today. Hope this was beneficial, and I hope if you're looking at making this transition, this highlighted a few very important points. So just to summarize, make sure you've got a team, make sure you know the implications, and then feel free to reach out if you have questions or you'd like to set up a call to look at any of these issues. So with that, I want to thank everybody for taking part today. Hopefully this was helpful, and thank you all for listening.
Eric, thank you for having us and
Thank you.
hosting this.
Yeah.